Welcome back. We are on Chapter 12, Statement of Cash Flows. And we just did a short introduction to the Statement of Cash Flows. And so I want to spend some time in this lesson going over a problem from the textbook. And that problem is CP12-4/CP12-6. And we can find that problem on page 598 in the textbook. Now, the reason why it's a combination of two problems is because in CP12-4 we are asked to prepare the statement of cash flows using the indirect method, and all of the information we need to prepare the statement of cash flows is presented in problem CP12-4. And then in CP12-6 we're being asked to prepare the statement of cash flows using the direct method with the information that is presented in problem CP12-4. So that's what we're going to do. I prefer the direct method for preparing the statement of cash flows. I think especially for the beginner, it's a whole lot easier to be able to get a better idea of the segregation of transactions, which we call activities, on the statement of cash flows, to separate those transactions or activities into the three classification groups: operating, investing, and financing. And so the information presented in problem CP12-4 shows us the balance sheet account balances for 2009 and 2010. These would be the year-end balances, December 31, 2009 and December 31, 2010. It shows us the income statement account totals for 2010. And then below that, it shows a few items which are called additional data, information that we need to be able to complete the statement of cash flows. That's what we need at a minimum. The information that we need to work with includes our balance sheet account balances at the beginning of the period, our balance sheet account balances at the end of the period, and to work from beginning to end, we need our income statement account balances, and in many instances we need additional data that explains different types of transactions that occurred, that affected different accounts in our financial statements. And so again, that's a little bit vague, but let's see if we can work through this and make some sense out of it. Now, normally I like to work through this type of problem from scratch, meaning that we start out with a blank sheet of paper. I like to use T accounts to illustrate putting together the statement of cash flow. And then as we move through the problem, we can add the information transaction by transaction. But in order to save some time for purposes of putting together this lesson, I've completed the problem. And so hopefully we can run through it, and hopefully it'll make some sense. So we always start at the top and work our way down. And when we work on the statement of cash flows, we want to start with our income statement balances first. And so the first item on our income statement, again, this is problem CP12-4 on page 598 at the top of the page. Income statement balances. Our first item is lessons revenue, $75,000. And so what we're doing here is recreating transactions for the year in T accounts. Recreating transactions that occurred in total for the year in using T accounts. And so our lessons revenue would show up as a credit in the lessons revenue account. So we credit lessons revenue 75,000 and we list that as item A. And we assume that unless stated to the contrary, we assume that all transactions occurred on credit. Again, unless stated to the contrary, unless the information says it wasn't a credit transaction, it occurred using cash. So for sales of 75,000, lessons revenue of 75,000, we show a credit, and the offsetting debit for that transaction would be to accounts receivable. So we credit lessons revenue, debit accounts receivable. Now we want to complete the accounts receivable account from beginning of year to end of year. The information provided us shows us that the beginning balance in accounts receivable, the December 31, 09 balance, which is the beginning of 010, January 1, 010, is $3,500. So we show that $3,500 balance here as the beginning balance in the account. And it also shows us that the ending balance in accounts receivable at December 31, 010 was $2,000. And so with that information, we have the beginning balance, we have the ending balance, and we have the debit to accounts receivable. And so we need to figure out, this is already in there, we need to figure out what the credit amount in accounts receivable is. And so we do that, you know, this becomes kind of a math mini problem. We need to, the left side of the asset account are pluses, the right side of the asset account are minuses. And so working with that information and the information shown to get the item that to get the amount that we need to calculate. In this situation, I would take the beginning balance and add the amount added, 3,500, add 75,000, and then I would subtract the ending balance, and that would give us the credit in that account, or the amount subtracted. If we were to check it, we would simply start at the top, 3,500 plus 75,000 minus 76,500 equals $2,000. So we simply check it by adding that account from top to bottom, and since it's an asset account, we add the amounts on the left side and we subtract the amounts on the right side. So our credit to accounts receivable is 76,500. And what does that amount represent? What is the offsetting debit to this credit in accounts receivable? And that would be a debit to cash, which reflects cash collected from customers. So, and we have essentially calculated the first amount that will show up on our statement of cash flows. And since the accounts analyzed are current assets, accounts receivable, and revenues, lessons revenue, that amount would be classified as an operating activity. It's a little complicated starting off, and so, you know, like with everything else in this course from beginning to end, it takes time and it takes practice to get familiar with what we're doing. So again, we have calculated the credit amount in accounts receivable, and it is offset by a debit in the cash account, and that debit of $76,500 represents cash collected from customers, which, as you might tell, is a little different from our lessons revenue, which was $75,000. Now, if you thought about that for a minute, you might wonder, well, why in the world is cash collected from customers, $76,500, different from lessons revenue, $75,000? And the difference happens to be $1,500. Well, the difference can be calculated by simply subtracting the beginning and ending balances in the accounts receivable account. We started out with $3,500 in accounts receivable, and we ended with $2,000 in accounts receivable. So we not only collected all $75,000 of our sales for the current year, we also collected another $1,500 of sales from the prior year. So the total amount collected in cash for this year is $76,500. Again, the credit to accounts receivable and the offsetting debit to cash. Now that explanation took quite a while, and if I was to take that amount of time for to explain every transaction that we need to go through to finish this problem, it would probably take at least an hour. And so we need to take a few shortcuts. But let's do this one at a time and see what we can cover in about 15 minutes. So again, if we go back to our problem information, the next item is wages expense. Wages expense was $70,000. And if we look at the balance sheet accounts, we see that we have a wages payable account. So relationships of accounts, wages expense, wages payable, those two accounts, anytime there's a wage transaction, those two accounts will be affected. So we need to show wages expense, and this comes from our income statement information. And wages expense is a debit of $70,000, and so we list that as item C. And our offsetting credit, again, assuming that transactions are on credit. Transactions occur on credit unless otherwise stated. Our offsetting credit would be a credit to wages payable. So the transaction would be debit wages expense, $70,000, credit wages payable, $70,000. Then again, we look at the balance sheet account, beginning balance, ending balance. And we get that information from the problem information presented. Our beginning balance in wages payable is a credit of $1,500. Our ending balance in wages payable is a credit of $1,000. And so again, just as we did for accounts receivable, we need to calculate the amount of the debit for wages payable. And so again, we take the beginning balance and we add the $70,000. This is a credit account, so our pluses are on the right side of the account. Our minuses are on the left side of the account. We take our beginning balance and we add the 70, and then we subtract our ending balance to get the amount subtracted. And again, we can check that by simply adding up the account from top to bottom. 1,500 plus 70,000 minus 70,500 leaves us a balance of $1,000. So what does this $70,500 amount, which is a debit in wages payable, represent? Well, anytime we debit a liability, that means we have made a payment. And so the offsetting credit for this debit of $70,500 in wages payable, and since it's a payment, it would be a credit to cash. And so this would be the second item for our cash statement of cash flows. $70,500 cash paid for wages to employees. Again, we ask the question, well, why is cash paid to employees for wages different from wages expense? Wages expense is $70,000 even, yet cash paid to employees for wages is $70,500, $500 more. Well, again, we find the answer by looking at the beginning and ending balance on the balance sheet. Notice that on our balance sheet account, wages payable, we started with $1,500 in that account, but we ended with $1,000. So what that means is that in addition to all of the $70,000 of wages expense for the current year, 2010, we also paid another $500 from the previous year, because our balance went from $1,500 to $1,000. So we paid a total of $70,500. $70,000 for this year and $500 from last year. And again, I'm just trying to provide you with different ways to look at the information so as to try to get a better understanding of what these numbers are, how they are calculated, and what they mean. Okay, so we have worked through two of the amounts that show up on the statement of cash flows. The next item is an interesting one. If you take a look at the income statement information at the top of page 598, it shows depreciation expense. Now, how do we record depreciation expense in our books? Depreciation expense, if you recall from chapter 9 or 10, where we studied fixed asset, long-term assets, and depreciation. Depreciation expense is recorded with a debit to depreciation expense and a credit to accumulated depreciation. And again, to go through the process, we would take a look at the balance sheet account, accumulated depreciation for equipment, and note that the beginning balance is a $2,500 credit, the ending balance is a $3,000 credit, and so our $500 of recorded depreciation, debit depreciation expense, credit accumulated depreciation, apparently reflects all of the information for these two accounts for the entire year. So those two accounts are complete. Depreciation, again, looking at the transaction for depreciation, debit depreciation expense, credit accumulated depreciation. Depreciation does not affect cash. Therefore, it does not show up on the statement of cash flows. So we are done with depreciation and at least for this problem, also with the accumulated depreciation account. And there's one other item that shows up under the income statement accounts, and that is income tax expense. And this one is a little bit different. If we were to take a look at the additional data, and we need to review that additional data at the beginning when we start the problem, just to get familiar with what those different items are that we need to consider as we're working through the statement of cash flows. If we look at item C under additional data, it talks about accounts payable, and then in the next sentence it says, because there are no liability accounts relating to income tax, assume that this expense was fully paid in cash. So if you recall, I said earlier, we need to assume that all transactions are on credit unless otherwise stated. So this would be an example of of a transaction that is not on credit, but rather for cash. And we can verify that by looking at our balance sheet data, and we see no liability account income taxes payable. Therefore, what would the transaction have been to record income tax expense if it was simply paid for in cash? I think it's on the next page, and I have it down here. Our transaction would be recorded with a debit to income tax expense and a credit to cash. And so this would be a third item that we have calculated that shows up on the statement of cash flows, and we would call that item cash paid for income taxes. And that would be an example of the amount that shows up on the income statement, income tax expense, is exactly the same as the amount that shows up on the statement of cash flows for cash paid for income taxes, $2,000. So we have calculated another amount for the statement of cash flows. I think at this point I'm going to end this lesson and come back to it in a couple of minutes, so that those of you that feel comfortable with what we've done so far, you can simply go on to your own work and work through the material that needs to be completed. For those of you that need to continue, we'll continue with another lesson, picking up exactly where we left off. So thanks again for your attention, and we'll be right back. Thank you.